All right, I promised you at the beginning we were going to talk for a few minutes about buying a house. Adam was obviously super glad he didn't buy a house in Atlanta. And my caution with buying a house is that you don't want to buy a house until both your professional and your personal life are stable. And obviously, in this case, he was still in a partnership track that didn't feel real stable. It turned out to be less stable than he thought it was going to be. Doesn't sound like, with a partner that he was necessarily in a stable personal situation either. So, not a great time to buy a house. Thankfully, he did not, because chances are he would not have recovered the transaction costs of buying that house, selling it only a year later. And that's a real problem. You can lose a lot of money, right? The round trip transaction costs for a house are about 15% total. About 5% going in, about 10% going out on average. And if that's a $500,000 house, that's $75,000. That house doesn't appreciate $75,000 in the time you own it. You're going to lose money. Aside from the hassle and the time of ownership and buying and selling and all that kind of stuff. So, when your life is stable, buy a house. I'm a big fan of home ownership, right? In the long run, you're putting, some sort of a cap, some sort of a limitation on what your housing costs are. They generally do go up in value over time, right? Time heals all wounds in real estate. It's the right thing to do. If you're going to be there for longer than 3 and especially longer than 5 years, you usually come out ahead buying a house. Less than that, it's a gamble. And so, as a general rule, you want to make sure you're going to be there for years before you buy. Now, doctors in their first year out often don't have a lot of cash, and they've got a lot of uses for cash. They've got the credit card they have to pay down, like Adam had. They've got a car loan. They had to replace that beater they bought as an undergrad, or they've got student loans to pay down, or they want to max out their retirement accounts, or they want to build an emergency fund, or they want to buy into a practice or open their own practice or save up a down payment. There's all these other things competing for your dollars. And this is where a physician loan can come in. The idea behind a physician loan is you don't have to put down 20%, but you can still avoid private mortgage insurance. Remember, private mortgage insurance, or PMI, is that insurance that the lender makes you buy to cover them, to cover the risk of you defaulting on the mortgage. It doesn't actually help you at all. So avoiding it is a good thing. And the nice thing about a physician mortgage is, despite not putting 20% down, like you would have to with a conventional mortgage, you can put less than that down and still not have to pay PMI. In addition, they generally don't require you to show pay stubs for a few months. A contract is good enough. They only look at the payment that's due on your student loans rather than the entire debt balance. And so it just works out better for lots of docs trying to buy their first home in the first year or two out of their training. Now, if you've got a down payment, if you've taken the time to save one up, if you didn't have a better use for your money, great. You can just get a conventional mortgage. But that doctor mortgage makes sense for lots of people for their first home. Don't let it cause you to buy a home before it's the right time to buy it. But when it is the right time to buy it, it's okay to use a physician mortgage and use that limited cash for other potentially better purposes, like paying down your student loans or maxing out retirement accounts, those sorts of things. Now, as far as how much home to buy, my general guideline, and it's a rule of thumb, so it's easy to find exceptions to it, obviously, but don't assume that you're an exception just because you can think of an exception. The general rule is keep the mortgage to no more than 2 times your gross income. Not what you think your gross income will be someday, but 2 times your gross income now, or in the contract you just signed, etc. And what that does is that helps you to not be house poor. It allows you to have enough cash flow each month to continue to build wealth. Now, in high cost of living areas, that often requires you to stretch that a little bit. That was easier when interest rates were low. Now that interest rates are kind of back to historical normal of 6 or 7%, that's a little bit harder to do. But when I say stretching, we're talking 3 times your gross income. We're not talking about 10 times your gross income. If you go buy a 10x house in San Francisco, don't be surprised when it dominates your financial life and potentially even lose it because you can't take care of it in the event that something happens to your income. So be careful how much home you buy. Try to keep the mortgage itself to less than 2 times your gross income. That might require a bigger down payment. It might require, more likely, a less expensive house. Other guidelines that can be useful is keeping what you spend on your house, including mortgage, taxes, property taxes and insurance and utilities to less than 20% of your gross income. That's another good guideline to follow. They'll lend you a lot more money than that, but taking it out is likely to impede your wealth building progress. A home does help, but it doesn't help nearly as much as putting money toward investments. All right. If you need our help with a physician mortgage, you can go to whitecoatinvestor.com/mortgage. We've got options there for physician mortgages, conventional mortgages, mortgage refinancing. As interest rates fall, you'll be able to refinance through links there. Keep in mind that you marry the house and you date the rate. And hopefully, as rates fall, you'll be able to get a better deal than when you first bought the mortgage.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.